Welcome to the 10 Mil Club Standard Portfolio Meeting for the 5th week of June, 2026.
From Nashville,
It's the 10 Mil Club. It's the 10 Mil Club.
Welcome to the 10 Mil Club's Standard Portfolio Meeting for the 5th week of June, 2026. What is the 10 Mil Club? The 10 Mil Club is an informal group of people who all believe that if we could get to $10 million of net wealth, we would have financial freedom. If you believe that, you're in the 10 Mil Club, and we welcome you. This week, kind of have a relatively short list to go over. As usual, we're going to take a look. This is the very difficult to read advanced decline line for the Russell 2000. It's a little tough to see, but you can see that the 21-day moving average kind of moved down a little bit in the last couple of days of the week. Let's get a little better view of this. That's one day. There we go. All right. The last part of the week actually showed more decline than it showed advance. We had advance through the early part of the week and then decline in the latter part of the week. The percentage of S&P 500 companies trading above their 200-day moving average is about 65%. This one we may actually want to zoom out on just a little bit. Let's go to 2 years by the week. All right. You can see we're not as strong as we have been at points in the past where we got as high as 80%. Now, if you watch Dave Keller and his market misbehavior channel, as we do here at the 10 Mil Club, we hang on his every word, and we highly recommend his stuff. What he gives away for free is fantastic. At some point, we will probably become premium members because, if nothing else, but as a thank you to what he does. Dave Keller's Market Misbehavior podcast on YouTube. Dave made the point this week, and this is well taken, that you can't have 100% of S&P. I mean, I guess in theory you could, but you're almost certainly not going to have 100% of S&P 500 companies trading above their 200-day moving average. 65% is actually pretty high and probably due for some sort of correction. Now, we're not calling for any kind of correction here right this second, but that is getting pretty high. So just to consider that. The percent of S&P 500 companies trading above their 50-day moving average is also above 65%. Now, these highs are higher than that high. This is the Iran war onset, where the market really took a dive and then recovered to these levels. We're not saying that there's going to be a big retracement anytime soon, but if we're going to go, let's do what we usually do, which is the S&P 500. So S&P 500, we like to follow SPYM, and the reason is for the worst possible reason, because if you I think the most common one is SPY, I believe. SPY is $744 per share. With SPYM, you can buy pretty much the same exposure for $87 per share. And it's just the share price that draws us to that one. The exposure is very, very similar. I guess there are a few small differences, but they're relatively remote and probably don't bear mentioning right here. But SPYM, you can see the rise here from the onset of the war up and then across here. Now, you do need to know, trend lines like this that are drawn are arbitrary. The more we study technical analysis here in the group, we know that really what matters are these moving averages. This is the 200-day moving average. Some we're finding choose to follow the 150-day moving average instead of the 200-day moving average. That's the 200-day moving average. I think it's kind of the de facto standard. That's the yellow one's the 50-day moving average here, and the burnt orange one is the 21-day exponential moving average. Those other two are simple moving averages. This one's the exponential moving average, and these gray bands, of which the middle one is actually this burnt orange band. These, I believe, are called Keltner bands. They're a variation on Bollinger bands, and we could get into all that. That's relatively heavy-duty technical analysis, but you can see that the S&P 500 is pegged right up against the top of this band here, and has kind of gone into going sideways. Dave Keller and the like have pointed out that the uptrend is actually still in place. This is not, as of yet, a bad chart. It's just at the moment, I think we could agree that it's a sideways chart. This is 2 years by the week. You can actually see the volume, the high volume right here in the sell-off as the war begins, and then the the decline in volume as the market retraces north again. And then we've entered this consolidation period. Now, we don't know. I'm going to go to let's go to 6 months one day here of the consolidation period. Now, again, if you're drawing these lines, it is arbitrary. Okay, where you draw them is where you see them. To a certain extent, that is I guess that would be called like a triangle. Honestly, I'm working on these. That is some sort of consolidation pattern, whatever you want to call it. We're waiting to find out if we're going to break out above that and take off and continue, or if we're going to break below the lower limit and begin a sell-off of some sort. Just don't know. But you do need to know that the uptrend of the S&P 500 is actually still in place. S&P 500 used as a proxy for generally the entire market. VIX is the volatility of the market. Here we are with 6 months of it. We're in the 15s this week. That's showing a relatively placid market. Low VIX generally means calm in the market, so the potential for higher stock prices. We know that there is a negative correlation of about 80% between the VIX and the and stocks themselves. Choose your index. Usually it's the S&P 500. We watch these here. This is the ProShares short S&P 500. This isn't. We would buy this if the S&P 500 became a bad chart, as Dave puts it, and down we would go. We would buy that because we could actually make money with that going up. And this is the short QQQ, which the QQQ is the NASDAQ. Those are short, and so don't. We are certainly not going to buy those this week. So one last thing, the VIX is the volatility for Standard & Poor's 500 futures, which is interpreted to be a volatility measure for the Standard & Poor's 500 itself. The MOVE index is generally viewed as the volatility index, or the standard, or the VIX for bonds. Had a little bit of a rise here, but nothing to be concerned about. This is, of course, the onset of the war when bonds were really showing a big concern. Right now, just not showing a whole lot of concern. It's interesting that that's the way the market is, because if you follow the news cycle, there's a lot that's been said about how you can end up doom scrolling and that kind of thing. That's not what we're really talking about. There's a lot to be concerned about out there, but the markets simply aren't showing that kind of concern right now. The S&P 500 is showing a sideways pattern, but the uptrend is still in place. So at the moment, we're not showing panic and downward pressure. One thing I do want to cover before we go into individual stocks, I want to talk about crude oil just for a second. /CL, this is it. So this, over this direction, is crude oil at $55 to $65 a barrel. Then we had the onset of the war. then it's not going to be so bad, then it's really bad, then it's not going to be so bad, then it's over, then it's not, then it's over, then it's not. That's the way it's been. And then crude oil just craters, starting at about early June. Crude oil just craters. Now, what this has done is it's actually lifted a set of stocks that are of companies that are very sensitive to crude oil, like airlines, for example. Earlier, before the show, before the taping of this show, we were actually looking at Alaska Airlines, because Alaska Airlines actually manages their capital stack relatively well, climbing debt but declining share count, relatively good operations. And with the decline in crude oil, of course, the thinking is with jet fuel being one of the major input costs of airlines and lots of other industries, those industries should do well. So with the decline of crude oil, their stocks have actually gone up. It's a lesson to all of us that when you have some sort of market shock like this, and then we see sort of a decline on that, and any sector that's been sold off, we need to go find the gems. As my dad puts it, we need to go around finding the rubies stuck in the mud after the flood. That's what he says that I do a lot. So with that, let's get to it.
10. Milk Club.
Going it old school.
This week, we actually bought some AXSM. This is AXSM Therapeutics. And at the moment, we're up just ever so slight of an amount, like 0.12%. But we haven't owned it but just a couple of days. The reason we did that, the DMI here showed a DI plus above the DI minus, a relatively high ADX. Now, the ADX may not be pointing in the right direction, but the moving averages are all stacked in the right way. And this was actually the piece that really brought it home for us. This is the 21-day exponential moving average, which we've started watching a lot closer. The 200-day and the 50-day are actually simple moving averages. The 21-day exponential moving average is a little different. It's not a simple moving average, exponential. So it weights the nearer days than it does the further out days. And the stocks seem to touch it, respect it, and sit right there. And so we took a chance on AXSM and bought the stock. We'll see how that goes. BYRN is, if we have to go back just a little bit, right here. So this is a year of BYRN. There's a bunch of mess back over here where we tried to do some things with BYRN. It didn't work out. We didn't know as much as what we were doing, but anyway, BYRN goes down, 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 and then crosses. Now, BYRN's situation has changed a bit. The DMI stacking has actually improved, and the RSI is now at 65. An RSI over 60 for a stock that's down like this is kind of showing a shift. So we're kind of looking for, we have a note here that basically tells us, okay, look, try to find a buy-in for this. You can see the volume up. We're going into earnings. A lot of times what has a tendency to happen, look, insider trading must be the most difficult thing in the markets to prosecute, because it sure looks like the market will know, the market of buyers will know things before us great unwashed do, and that includes me. So this right here, it's rising going into earnings. Earnings appear to be the 8th, which will be this week. So we're looking for a spot to buy in BYRN. Now, BYRN only has 22,600,000 shares. You can see it right here. That stock has the ability to really move a lot if its earnings surprise. So we're kind of, hope's not a good plan, but we're kind of expecting in the days leading up to these earnings, possibly getting a few down days that bring us back closer to the exponential moving average, 21-day MA. So maybe we can buy into BYRN. That would be a risk. We would have to decide whether we wanted to take that or not, but that may be something we're doing this week. Citigroup's new on our list. It's above the 200-day moving average. This is a year of Citigroup. It has migrated back to its 21-day EMA, and if it respects that for a day or two, we're probably going to buy into Citigroup. Everything else down here. Now, in an uptrend, Dave Keller tends to like a stock, and look, Dave's our hero. That's the way it is. He tends to accept an RSI over 50 in a stock that already has an established uptrend, and this kind of fits that bill. So Citigroup may be one that we'll be looking into. Campbell's company, Campbell's Soup, has had declining revenue for a long, long time. But what we're seeing now, this is 2 years of Campbell, what we're seeing now is a shift from a lot of tech and that sort of stuff into some more defensive companies, and some of these companies are starting to get it together. So, in fact, we're going to look at General Mills here in just a minute, which is another one of those examples. But Campbell's kind of began, if we get off the weekly here, we have some indicators here that Campbell's may actually be something we want to pay attention to. Now, let me back up to 2 years here. Remember that these lines that we draw are arbitrary, and it hasn't really crossed completely over the highest line yet. That is not pure technical analysis. In fact, Dave would probably call it fake technical analysis. But if you're simply drawing the line, this long-term line, it's giving us reason to take a hard look at it. And so we probably will be over the next little bit. CVS, full disclosure here, we owned some CVS. It was retracing. We had bought it at a price, 96.36, where we were like, yeah, we can't handle a retracement of that. We should have drawn a line and bought back in at this point. We need to pull back to the 21-day moving average before we can buy it again, and we may get that over the next little bit. I don't know, but sold a little too quick. We do that all the time. We just do, and that's the way it is. But it's on the list for this week. Now, Dollar General actually came and touched the 21-day moving average, so we're actually looking for a buy-in at Dollar General. There's a lot of stuff here to look at on Dollar General, but we have an alert here to let us know. So DG, Duolingo, we made a study. So I'm going to go to 2 months, 1 hour on Duolingo. All right. We made a study of Duolingo this week, and we have not bought back into Duolingo. And you might think, well, you idiot, why didn't you do that? Well, Duolingo, all right, 6 months, 1 day. Historical volatility right here. Duolingo's historical volatility is currently 63% on a 14-day look-back period. That is not as high as volatility can get for a stock, but it's still pretty high. Look, it's a tech stock. It's going to be high. So 2 months, 1 hour. We followed Duolingo. We tried to trade it right here, got stopped out. We went, okay, we're going to wait for it to cross that line. We know the lines are arbitrary. Down it went. It crossed the line. We only saw it before market open right there. And we had a conversation, and we went, do we buy it before market open? The answer should have been yes. Instead, what we did was, no, let's hang on. And from that moment on, we haven't had, unless we were, I remember the next day there was somewhere in the neighborhood of 1 minute that we actually had the ability to buy it back at that low point. Duolingo may be off to the races. It's okay. We're watching it because we got to figure out a way to nail some of our entries here. But Duolingo, if we get a move back down into this area, this 115, 116 area, and we see it, we will almost certainly buy it. All right, General Mills. 2 years of General Mills shows you this. A stock that just goes down, 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 down. Pretty easy to know why. The whole Make America Healthy Again movement, where moms are wanting less artificial colors, less artificial flavors, and it's expensive for companies to change over and do that. Plus, General Mills hasn't refreshed its portfolio of food offerings in a long time. Look, they have some of the best, Kraft macaroni. I'm sorry, not Kraft macaroni and cheese, but they have lots of cereals and they do have a macaroni and cheese. They have a lot of stuff. But their stock's just falling and falling and falling and falling for a long period of time. To be fair, they're not over this arbitrary line that we've set. But in their earnings this past week, General Mills posted their first quarter-over-quarter increase in revenue in quite some time, at least 10 quarters, because we track 10 quarters here. And you can see the effect that had on the stock. Now, if we go to 6 months, so 200-day moving average is still way up here, really concurrent with our arbitrarily drawn line up there. But you can see the upturn in the stock here with those earnings. And so we're kind of, I mean, we're waiting kind of for a follow through here, but we may be buying General Mills, GIS, sometime soon. Global Ship Lease, GSL, we still own, down 1.04% merely because the stock's really kind of been going sideways. Every time we cash out of something like this and just go, well, that's enough, it seems to just go up after we, it says technicals aren't good, sell at a loss. Don't sell at a loss, though. Still holding GSL. It doesn't have horrible technicals, but we're kind of waiting for that stock to kind of take off. LOCO, El Pollo Loco Holdings. We are simply waiting for a retracement to that 21-day line. Has really good fundamentals. So that one, if we get back to that 21-day moving average, we will buy El Pollo Loco and Medtronic MDT. We've been following this because this is kind of a beaten down name where the moving averages have kind of shifted, and we got this really high move day on Friday. And so that was a break really pretty significantly above this regression channel right here. We'll see what happens Monday and early this coming week, but we may be buying into Medtronic. I'm going to pause here just for a second. We have both a Facebook page and a Facebook group. 10 Mil Club, looks just like our name, 10 MIL Club, 3 words. And we invite you to join our Facebook page and our Facebook group. And we'd love to have you be a member of them. Every day, what we do or what we thought of is posted on those in that group and on those pages. So we keep you up to date kind of with what we're doing with the 10 Mil Club. So once this video is posted, I will post the links to those pages down below. We hope you would join. Also, we would really appreciate it if you give our video here a like, and if you would consider subscribing to our channel. That really helps us a lot. So we would certainly appreciate that from you. NEXN is back on our watch list. NEXN, we need to move back to this 21-day EMA. 2 years of NEXN looks like this. We unsuccessfully had a few trades of NEXN back up here and then got off the NEXN boat. It then crossed and honestly is almost back up. We should have been in NEXN quite some time ago. We just weren't paying attention to it. So 1 year, 1 day of NEXN looks like this, down, 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 down. We really should have been on the NEXN train long before now. But a migration back to that 21-day moving average probably will put us back in NEXN. All right, this is our big success over the past couple of weeks. QLYS, QLYS. It's a software cybersecurity company. We talk about things that we should have been in like NEXN. This one simply presented itself and gave us a retracement like this, where the technicals still were good. The RSI was over 60, the DI plus was over the DI minus, and you could see the recovery from this dive down here. And so we bought it. Now, we didn't wait for it to touch the 21-day moving average. Our stop was reasonably low. So we simply went ahead and bought NEXN, and we kind of caught lightning in a bottle. It and a couple of other software stocks just simply went up. If you've been paying attention to that market sector, software got sold off really badly over the last 6 months to a year. The narrative being AI is going to replace all software companies. Well, maybe not all of them, and QLYS is probably one that is not going to. Progress Software is starting to show some signs of life. It's like, oh, maybe AI is not going to actually take over, not going to ruin the software world. And so we were up somewhere in the neighborhood of just under 30% when we finally went. That looks like a parabolic move to us. And so we simply sold QLYS. We sold it at 141. It's at 148. Look, we 29 point whatever it is percent that we picked up. Looks good on the books. SCI Service Corp. I'm in danger because I actually love this stock. If you run a fundamental scan on this, you'll find out that they manage the capital stack very, very well. I believe they're based out of Texas. Houston, Texas. And they are a death care company. One of the most boring industries you can possibly be in, which makes it a great stock, especially since it has really, really good margins. And we got stopped out of it once over here where we kind of expected it to simply be at the low end of its channel. And then once it dove down this way, we finally just bought it again at 70.40. We're up 6% at the moment on Service Corp International. Very, very low risk type of stock, especially since down in this area, their board voted to almost quadruple their share buyback program. Company has plenty of cash and operates very, very well. So SCI, we're up 6% and doing very well on it. We have to cover TMC, the metals company, only because we are the 10 mil club and people ask us about TMC, the metals company. Stock is, from a technical standpoint, at a low down here. Let me kind of zero in on it for 6 months, just a little bit here. And I'm just going to use this line. Again, these lines are arbitrary. Still underneath the line. A little bit of a loose cannon of a company. We've talked about this before. TMC, they are, I believe, waiting on they're waiting on a license to begin mining rare earth metals and critical minerals from the Pacific Ocean floor about 1,500 miles southwest of San Diego, California. I didn't even know that they were interested in iron, but you can see, get rid of me here for a second. You can see in the news down here in the lower left that they bought some royalties from an iron mine in the Mesabi range in Minnesota, and I didn't even know they were interested in iron in the Mesabi range. So, bit of a loose cannon of a company. It hasn't had any posted revenue as of yet that really kind of, I mean, here's their earnings. Probably shouldn't spend too terribly much time on them, but let's see. Press release, first quarter update. Let's see. Well, it says 5 cents per share. Or no, surely not. There we go. Okay, losses of 5 cents per share. Which, there we go. Let's see if we can get this. No, that's not on my. It's not on my screen. Okay, well, you'll just have to listen to me for a second. Losses per share of 5 cents, which is a 16.67% increase over losses of 6 cents a share of last year. So the company's still losing money. Don't know if they're ever going to make money. Really don't know. So moving on. TREX is new. You know TREX as the plastic lumber company. It's the name brand. There are other plastic lumber companies out there. But TREX, so construction materials has actually been somewhat on a rally over the last little while. This is TREX right here crossing over the 50-day, then the 21-day, and then pretty much after this point, June 5th, staying over the 21-day as it moves on up. We're looking for a return to support at the 21-day moving average, but if it does that, or does anything that looks like it, this here isn't it, but looks like it. If it does anything like that, we may actually be buying TREX. TREX is also a company that has a very good fundamental scan. Vera Bradley, we're probably going to buy back into this week. It shows all of the technicals So VRA shows all the technicals. We have our RSI at 57 and pointed the right direction. DI plus over the DI minus. And historical volatility letting off considerably. It looks like most recent historical volatility is now 57%. Not low by any matter of means, but certainly not this 83% area right here that followed their most recent earnings. And finally, Walmart. We got stopped out of Walmart this week, and Walmart has turned into what Dave Keller probably would call a bad chart. Down, we bought it, we were up a little bit, and then without warning, Walmart really just kind of sold off. And honestly, I don't know exactly why. We set this line right here. We have an alert on it to let us know, but Walmart really just cannot seem to get out of its own way. And it's annoying because Walmart's such a good company, but it is. We've actually heard rumblings that Walmart's valuation may be a bit too high. I don't know. We would have to do a weekly deep dive on Walmart, but that's not going to happen this week because I have a lot of work to do and a lot of reports due. And honestly, you're probably not going to hear from me again until next weekend. And that is the way we see it. So from all of us here at the 10 Mil Club production room, we thank you so much for being with us. And Sophie Hannon Presley, the 10 Mil Club singers, and Jackson, our announcer, on behalf of all of us, we will see you next time on the
10